We're going to go a little bit deeper into the accounting equation. In a previous video, I introduced the accounting equation. We talked a little bit about what the accounting equation is and how it works. Today we're going to go a little bit more depth. So just as an overview, the accounting equation is assets equals liabilities plus owner's equity. Some common examples of assets include this list here on your screen. Liabilities might include accounts such as these. And owner's equity includes capital stock and retained earnings. So we're going to expand a little bit here on retained earnings. Remember that retained earnings is the portion of the profits of the business that they've kept within the business to continue their operations. In other words, they've earned the money, they've paid all their expenses, and they have not given that money back to their owners. Instead, they've retained those earnings or profits within the business. So how do we calculate retained earnings? Well, retained earnings are equal to the beginning retained earnings, or whatever we started that period with, plus the net income, that's their net profit for the period, subtract any dividends, which are the amounts that are paid out to the owners of the business, and that equals their ending retained earnings. So if it's the first year that a company's in business, the beginning retained earnings would be zero. If it's the second or third year, you would take whatever they've accumulated from prior years in terms of their earnings that they've made in previous years and subtract out any amounts that they've distributed to their owners. So whatever we start with, we add to it current year profits, subtract out any amounts that we've paid to the owners of the company, and that gives us our ending balance for retained earnings. This is the amount that would be reported to the shareholders and users of the financial statements, that ending retained earnings number. So this can be broken down even further. Remember that net income is equal to revenue minus expenses. So revenue are the amounts that you've earned, excluding or not considering your expenses. So for example, if I sell some inventory, the amount of money that I receive for selling that inventory is what we call revenue. Then we're going to subtract out all of our expenses, all of the wages that we pay to our employees, the rent for the buildings, the cost of the inventory the amount we had to pay for it, and so forth. After we subtract all of those expenses, we get to what we call net income. So really, retained earnings is equal to beginning retained earnings plus revenue minus expenses and minus dividends, if you replace revenue expenses in place of net income there. So again, the accounting equation, assets is liabilities plus equity. We can look at having this broader understanding, a breakdown of the retained earnings. We can take a look at how this equation might work when we're trying to record transactions in the business. So the way that we increase an asset account is by debiting that account. You can see here I've got what we call a T account, which basically splits that account into a left side and a right side. The left side being the debit side and the right side being the credit side. And there's an upward arrow in the debit side indicating that we increase assets by debiting or putting something on the left side of that account. We would decrease the asset by putting something on the right side or crediting that asset account. Liabilities work just the opposite. If we want to increase a liability, we would we would credit that liability account, and by crediting that account, we would increase the liability account. If we wanted to decrease the liability account or show that we owe less money, we would put something on the debit side of that liability account. And owner's equity works just the same as liabilities. But remember, let's break the owner's equity up a little bit. So we've got revenue, expenses, and dividends, as well as our capital stock. And remember that the revenue, expenses, and dividends are our components of retained earnings. So how do we increase a revenue account? Well, we put something on the credit side, or we credit that account. If we want to increase an expense or a dividend account, we would put something on the debit side or debit those accounts. And then finally, capital stock, which is the other component of owner's equity. If we wanted to increase the capital stock account, we would credit that account or put something on the right side, the credit side of the capital stock account. So a good way to remember this is that debits increase expenses, assets, and dividends. So DEAD, dead. If you don't remember this in your intro class, you're dead. You got a debit. The debits are going to increase expenses, assets, and dividends. So if you look at the expense, assets, and dividends, T accounts, there you can see that the upward arrow is on the debit side of those accounts. If we credit those accounts, we're going to decrease it. Everything else besides the expenses, the assets, and the dividends are going to be increased by crediting those accounts. So our revenue, our liabilities, our capital stock accounts, those things are going to be increased by crediting those accounts. So we always have to have a debit and we always have to have a credit in our journal entries. Our debits actually have to equal our credits. Whenever we make any type of an entry into our books, the sum of the debits have to equal the sum of the credits. So if we debit an asset, meaning we increase that asset account, you can see on the right-hand side of the equation, we're going to credit something. So we may credit a liability. Doing that would increase the assets. It would also increase the liabilities. If we increase something on the left side of the equation and something on the right side of the equation, that's going to give us a balanced equation. We might also have a scenario where we increase one asset but we decrease another asset. So for example, if we purchase inventory, we're going to have inventory go up, that's an asset, but we're going to have cash that goes down, and that's also an asset. If we increase one asset and decrease another asset, then there's no change in the overall balances, the total balance, we're just moving it from one asset to another asset. So we're only manipulating the left side of the equation. So you can start to see a little bit here how this accounting equation, when you're looking at the debits and the credits and how they impact these accounts, how the accounting equation can stay balanced when we're changing things by recording journal entries. We'll get much deeper into that in future videos.